welcome to this edition of the Global Dialogue. I'm Shereen Bhan. The Global Board of McKinsey is meeting in India. This comes at a time when the global economy is faced with uncertainty and recessionary pressures. India still resilient in light of this volatility. Well, to talk about the road ahead, joining us now is Bob Sternfels, the Global Managing Partner at McKinsey. Also with us, Daniel Pacthod, Senior Partner, Sustainability at McKinsey, Katy George, Senior Partner on Talent, and Eric Kutcher, Senior Partner on Technology. Gentlemen and Katy, many thanks for joining us here on the Global Dialogue. Bob, it's good to have you back in India. You were here very recently. I remember you said that this is going to be not just India's decade, but India's century. Is that why you've decided to bring the Global Board back to India in, what, 3 years for the second time?
It is. Yeah, we were here as a board December 19 in Mumbai. And the world's changed since then. And then, as you said, I came in August. And I got so excited about what was going on, both in the country and with McKinsey, that I decided to bring the global board here for the end of year board meeting.
I'm going to talk to you about your commitment that you're going to focus disproportionately on India in just a second, but I want to understand from you what gives you confidence in the India story today. What are the factors that you're looking at? What are the factors that are looking better for India in this past year?
Well, first, I'm not naive that there are a lot of challenges out there, and India is not immune to those. As we think about inflation, as we think about difficult geopolitics, as we think about environmental challenges, India is not immune. But on the other side of the coin, there are things that get me incredibly excited. You look at the potential that is not unrealistic to sustain 7 to 8% GDP growth per year through India's 100th birthday in 2047. You look at the potential to move over 200 million people into the workforce from non-manufacturing jobs into manufacturing and other types of technology jobs. You look at the opportunity to add 200 million women to the workforce. So I get very excited about that potential, and it's really underpinned maybe by three things. One is this notion that India is the workforce for the world. Between now and 2050, India will be home to over 20% of the global workforce. Right? So this is the workforce for the world. The second is, I think the future of supply chains runs through India. You're seeing this unfold as everyone starts to think about resilient supply chains. There's up to $1 trillion of opportunity in India alone by reimagining supply chains. And then the third is the fact there's 650 million people who are digitally savvy today in India. And you think about the future of digitization and technology. So you mix those three things together, and I come out more optimistic than pessimistic, and it's why the notes where I should have said it was India's decade, and I actually believe that it's India's century.
Well, it's good to hear that, Bob, and we hope that it is in fact going to be India's century. But I just want to pick up on what you said there in terms of the interconnectedness of the world, which continues despite all of the talk around deglobalization, and the fact that people are building on supply chain resilience, and that is a boardroom conversation that's happened through the course of the pandemic, and more so today. The opportunity of what's happening in China and how that benefits countries like India, what that means at this point in time. Are we overestimating the shift out of China, and who could the potential beneficiaries be? Of course, India is one of them, of this sort of backup locations that people are looking at.
I think this is probably one of the biggest existential questions of our time. We've grown up under a regime of globalization, and you're already hearing the language of, is globalization dead? Do we deglobalize? Do we decouple? Do we nearshore? Do we friendshore? These are all the things that are being kicked around, and we just launched a report from our McKinsey Global Institute on the interconnected world that starts by first saying we should understand the fact base, and the fact base today is that we are more connected than we ever thought.
So we're not deglobalizing or decoupling?
Well, if we head this route, the answer is it would be incredibly costly to truly break apart. And that's underpinned not only with trade flows, but flows in data and IP, flows in talent, and flows in financial flows. And our estimates are this could be anywhere between 10 to 40% of global GDP could be at risk by doing this the wrong way. And I think the answer, to jump to your question, is actually reimagining globalization. rather than reverting to decoupling. And when you reimagine globalization, you might actually see much more diversification of routes. And so you start to think about, how do I become more resilient with talent, more resilient with trade, more resilient with energy security. And you start to say, rather than one or two dominant trading partners, should I have multiple trading partners? And I think then in that context, India could be a unifying source of a reimagined global world, as opposed to a world that decouples. It will require leadership, but I think there's a real role that India could play in leading that idea of reimagining globalization.
So, you know, in the context of reimagining global supply chains, you're actually saying that we're going to reshape the way that we look at globalization as opposed to deglobalizing. We're actually going to reshape the way that we look at globalization. Katy, let me address one of the issues that's been hotly discussed and debated through the course of the pandemic, and that what happens to talent, what happens to the future of work. And we've gone from, you know, the normal is going to be hybrid or work from home forever, to now saying we're back at work, and we don't know whether flexibility is actually going to be the order of the day. But you firmly believe that the new normal is not going to be pre-2019.
Absolutely. I think we have changed workforce expectations and the opportunity to leverage global talent forever. And we're not going to go back to the way it was, but we need to renegotiate what the future is going to be. So, you know, we see unprecedented times in workforce dynamics with still uncertainty, right, in the macroeconomic conditions and layoffs, for example, in tech in the US, but at the same time, huge job shortages and kind of a reallocation of where jobs are. In India, for example, in November, huge increase in insurance job creation, decrease in the growth in IT. And you see that kind of reallocation everywhere. COVID's accelerated digitization everywhere. That means that global digital talent, like you have in India, is going to be in high demand and is able to connect into more places than ever before.
You know, you talk about the fact that we've gone through this phase of the great resignation to quiet quitting, and now you're talking about the great renegotiation or the great negotiation.
Right.
But, you know, given the fact that the labor market continues to be extremely hot, and the latest print that's come in from the US also suggests that, even in this uncertain macro environment, how is that going to shape the labor market as we move forward?
I think that what we're seeing globally is that the workforce is demanding a lot more flexibility, not just in where they work, but how they work and how they progress their careers. We're all focused a lot on great talent retention, which is a huge issue for every industry and every function. And what we're seeing is that it's not just kind of traditional levers like compensation, but it is about providing workforce flexibility. It's about helping people connect better to a sense of purpose in the work that they do. And it is about career development and skill development. And so I think we're going to see more flexibility in how people work, more flexibility in how companies help people navigate careers. And those careers will be more interesting than ever before, in and out of individual companies, in and out of different functions, and with a lot more what we're describing as self-authorship in terms of how do you think about defining your own professional journey, because there are a lot more options now than people have ever had before.
Is this one of the top 3 things that your clients are focusing on or having you focus on?
Absolutely. This whole question of how do we navigate hybrid, how do we take advantage of the unique things that we can do with flexibility now in terms of being virtual, bringing global experts into any situation, creating more work-life balance and flexibility for our colleagues, our clients, employees.
So are we all heading to a 4-day week, or?
I don't think it's going to be rules-based. I don't think it's going to be a specific kind of policy-based answer. I think we're going to get much smarter about how we drive the outcomes around apprenticeship and skill building, how we drive outcomes around connectivity and relationship building, as well as outcomes around work-life balance and sustainability. And I think we'll see more things that, you know, in the office some weeks, out of the office other weeks, to create these balances. One of the things we're doing is really amping up our advanced analytics connection to our teams so that we can learn from our 4,000 teams around the world at any one time as to what choices are they making about co-location and how is that driving outcomes. And I think that outcome orientation is going to unleash a lot of insights that will be much more nuanced and more interesting than a 4-day-a-week or 2-day-a-week kind of answer.
Eric, let me take that forward to you and segue into what's happening as far as the tech space is concerned. It's been a bull run for over a decade that we've seen in the tech market, and we're starting to see a fair amount of correction. It's been brutal in some cases, but is the worst behind us, or do you anticipate that we're going to see difficult times continue?
So I think you have to start with the tech industry in terms of what they are doing is still very healthy. What has happened has been a pretty big reset in valuation, and some might argue that we got a little bit ahead of ourselves, in part because there was unrealistic expectations of growth over the long run. That growth is then discounted back at a much higher level now that we have higher interest rates. But the foundation of what tech is doing, I think, is going to continue. I just think that the stock market reset. I think when it comes to the labor side of it, we went through during COVID this incredible digitization era. That led to an unbelievable need to kind of bring people to continue to add capabilities. Some of that has now begun to slow. And I think as these organizations now look, they say, wait a minute, maybe all those things that we were getting ready to do aren't all the right things to do. They're kind of rethinking what they want to do on a go-forward basis, and that's what's leading to some of the job dislocation.
You talked about some of the assumptions that people made during the pandemic, and of course we've seen an acceleration as far as digitization is concerned. But I want to bring up 2 points. What Mark Zuckerberg said, that maybe we overestimated the growth expectations and the growth assumptions on the back of what the pandemic did, and we're now starting to dial that back a little bit, and which is what's resulting in the kind of layoffs that we're seeing. And 2, what Satya Nadella said, he said, look, don't think of tech jobs as people working with Meta or Twitter or whatever, but think of the auto companies because they're as tech can be. So do we need to change the narrative and the lens with which we look at this as well?
So there's 2 very different components there. Number 1, as we look at the tech companies, did they get out a little bit ahead of them? Maybe. But then the question is the talent still needed? I think Katy pointed to this. The talent is 100% still very much in demand, right? Because every company is becoming a tech company, right? You talk about whether it's the automotive company or whether it's the transportation companies, all of them are building new businesses. And I think that's really where some of the opportunity comes. It's not just the net new startups, it's actually these very large companies that are looking and saying, wait a minute, I've got to focus on growth, right? 8 out of 10 CEOs say one of their top 5 agenda items is building new businesses. 8 out of 10 say that. 1 out of 5 say it's going well. And a big reason why it's not is they have not been able to kind of bring together that talent, which I believe will start to kind of reallocate across kind of what is a much broader tech ecosystem than when you think just tech companies.
You talked about startups, and let me address this in the context of what we've seen happen here in India, because the last few years has been a big boom cycle for Indian startups as well. Given where interest rates are, it's very clear that the era of easy money, of cheap liquidity is over, at least for the foreseeable future. What's the long-term implication of that as far as the startup ecosystem is concerned, globally and specifically here in India?
Yeah, so I'll start with globally, where I probably have even more knowledge. First, I would say, if you look at, there's a lot of capital that's still being deployed at startups today. That is definitively true, and there's a lot of dry powder that is still yet to be spent. I think there's an enormous amount of energy and effort and dollars going at net new startups, much more at earlier stage, and not surprising when you see this type of pullback. What an amazing opportunity to kind of start now. I think the area where you're starting to see a little bit more challenge is in what is more that growth equity stage, the later stage VC, where we were getting to check sizes that were enormous. And I think a lot of that capital has pulled back. Part of it is I have to go back and defend the companies and continue to reinvest in the companies I've already placed my bets in. And there's a wave that just has to kind of work its way through. And that does mean some of these venture firms are choosing the winners or the ones that they're willing to bet on and ones they're not. And that will leave some a bit more struggling. And I think that is very much. In India, I am more bullish broadly in India. If I look out the next handful of years, I think you'll have more than 250 unicorns, right? That's an incredible thing to think about. And I tend to think here's probably got more opportunity, in part because the domestic market is so attractive.
Yeah. Yes. Well, we're practically minting a unicorn a week through the last year, but there's been a little bit of a slowdown. But Daniel, let's talk about sustainability. We've just come off the COP. And we're now sort of putting in place the decisions that were taken there. How significantly different is the approach within organizations, within the corporate sector, in being able to address this? I mean, you know, a lot of people were focused on where the ESG money is going and how do you sort of reorient or reshape strategy to make use of that. But in light of where things currently stand, how aggressively are corporations thinking about sustainability?
So you said COP, and I think, you know, Bob, we were there a few weeks ago in Egypt, and what a difference a year makes. Because a year ago, everybody talked about net zero. And now, after the energy crisis, the discussion was really about energy resilience. It was about net zero, and I think we talk a lot about the power of the and. And I think a lot of leadership teams, by the way, governments or companies are starting to realize you got to balance both.
Yeah.
And, you know, more and more you talk about a transition that has to be affordable, it has to be secure and clean. And that conversation really was not in the room a year ago. And I think what is also super exciting, I think, and I think we're thrilled, I'm thrilled to be here in India because our colleagues have just launched a report on decarbonizing India, is the leaders of tomorrow, countries or companies, are playing offense. And I think what we saw a lot in Sharm el-Sheikh, but frankly also in the conversation I've had in the last 2 days here, is that, you know, the CEOs or the leaders that are saying, you know what are the next 5 businesses I need to build? And that whole wave of green business building, you know, Eric talked about technology, and I'm also a technologist by heart, but I think what you see is the progress we're making and the amount of capital that's going to be deployed. I mean, this is the capital reallocation of our time. And I think that's where you see a lot of movement now, which is people are starting to put real bets on, you know, hydrogen, on carbon capture, on long duration storage, and frankly also building renewables, which is a big part of what's going to happen here in India.
Time for us to head into a break here on the Global Dialogue, but we resume our conversation when we're back right after this. Welcome back. You're watching the Global Dialogue, and we're in conversation with the senior team at McKinsey, the McKinsey Global Board, meeting in India. The view is that countries like India can play a leadership role in being able to drive down prices, just as we did on the solar side. Could that happen potentially for something like green hydrogen? What's the expectation? What are the assumptions at this point in time? How far are we from reaching any kind of a meaningful inflection point?
So the cost curve on green hydrogen has changed massively in the last year and a half. When you have the conversation here in India, we still have a lot of work to do to get to a cost curve that's going to be affordable for India. And I think that's perhaps the biggest difficulty here, which is we've painted a picture of what the transition could look like to 2050 and 2070. And it's pretty exciting. And by the way, the thing that you also realize, 75% of India has not been built yet. So as you look at, you know, the carbon footprint you have today and what you have to build, you know, we actually have one advantage, which we don't have the incumbency of a US or of Europe. But I think the cost curve on green hydrogen hasn't moved that fast yet. But, you know, globally, and we're part of the Green Hydrogen Council, I think 500 projects have been announced till 2050, $160 trillion committed. So I think capital in the last 18 months has really moved. And I think it's going to be important for India to also attract capital, especially on green hydrogen.
You know, you talked about capital, and there's a lot of talk around climate financing at this point in time, but also in the context of the energy crisis that we are seeing, the cap coming in as far as Russian gas is concerned, you know, OPEC at this point in time doing a rollover, not looking at changing production just yet. But these are all sort of volatile factors that one needs to worry about. Yeah. Does it set back the kind of ambition that we had globally on doing this transition?
Yeah, so this was frankly a big debate, which is it basically an either or, and do you basically now focus on the energy almost resilience and fix the energy crisis and push out your aspirations for net zero? And I think it's really the and that we come back to. And so I think even for India, I think, you know, to some extent we have to move on the transition to net zero and on renewables, because it will make us more secure. The biggest issue is really the transition period. And then from a financing perspective, you know, we talk a lot about the north-south dynamic. I mean, this is perhaps an area where there was real disappointment in Sharm el-Sheikh, which is, I think, we still haven't resolved, if you want, the financing gap. And I think a lot of the discussion even here is we've got to almost reinvent some of these financial institutions like the IMF to create different mechanisms and different financing conditions to actually attract more capital to come to places like India.
Well, that's going to be part of the conversation here. India has, of course, taken over the G20 presidency, and this is going to be one of the aspects that gets taken up. But, picking up on what we just heard there from Danielle, Bob, what I want to address with you is when you speak with CEOs, given the uncertain macroeconomic climate, how willing are people at this point in time to take the large strategic bets, or are they putting those bets on pause, defending the present versus attacking the future?
I think this is a great question, because as we peer into 2023, there's probably been never a time in history where you could see a wider range of outcomes. And it varies where you sit in the world, what industry, and what geography, but there's a really wide range of scenarios. And so then the question is, do you get defensive, do you play offense? And the other part I would throw into this is companies, well, I'll take a private sector lens to this, are entering 2023 in a healthier position than they ever have been. Right? If you look at corporate balance sheets, if you look at corporate earnings, we're not in 2008, 2009, we're not in 1999. It's a different period. So you come in healthier, and I think the name of the game on everybody's mind, I'll steal a different context, Daniel, from what you said, is how do I be resilient through 2023? And then to get more specific, what company CEOs are asking is, I want a balance of offense and defense, not one or the other. And we did some research, and companies that went through the last 3 downturns that only played offense had one of 2 outcomes. They either radically outperformed or they dissolved. Unfortunately, 80% dissolved. So that's a pretty risky strategy if you only go offense. The companies that only play defense, the good news is you would survive. 75% of the companies that did this survived, but you had a 90% chance of coming out average. Right? Then there was a very small percentage, it was only 8% of the companies that did both. But those companies outperformed by 50% all their peers.
The value of stagility.
Well, exactly, right? It's a new, I'll steal the term. Right?
I stole it from you.
Exactly. But I think there's this, there is this obsession with, how do I do both? How do I take all the measures to shore up the balance sheet, take the efficiencies, because particularly in some sectors I've been going through a decade where I haven't really looked at that, but at the same time preserve the option to make 2 or 3 strategic bets. Can I invest in technology to transform my business? You asked the question on the commitment to net zero. Not one of our clients has retraded their net zero commitment globally. Right? So it's the idea of, I'm going to move forward, be efficient. I'm not retrading my commitment to net zero. And as valuations change, perhaps there's acquisition opportunities that are going. So I think this notion of balance, offense and defense, is what I'm hearing from CEOs' minds. I will say, though, it's incredibly hard, because stakeholders usually want one or the other. And so as a CEO, it's a pretty lonely role to present a balanced set of initiatives and then try and get everybody aligned behind it.
So, Eric, are we likely to see more offensive bets, or tech companies hunker down and go into defensive mode at this point in time? And where do you believe we are likely to see disruption? I also want to understand from you, in light of what we've seen happen with the recent crypto collapse and FTX, etc., does this sort of push back this whole shift and move towards cryptocurrency, blockchain, metaverse, and what have you?
So within tech, I don't think there's any company that's taking their foot off the pedal in terms of strategic bets. And I think you've seen that. You've seen that from companies that are going into the metaverse. You're seeing that from companies that are continuing to make the bets, both consumer and enterprise. I do think, to Bob's point, they are dialing back and saying, where are the things that we frankly don't think were the investments we should have made? And where is it we just put too much resource at things we didn't need to? And so they're definitely dialing back. But I think tech's one view of the world. I think when I see when I talk to many other industries at this point, most are kind of foot on the pedal and thinking about what are the 1, 2, or 3 big bets they can make. And to the point around acquisitions, I am absolutely seeing the acquisition market begin to heat. And it's different. It's not consolidation for the purposes of cost out, which is often what you see in what looks like a deeper recession. It is much more about, how do I take this to take advantage, to move into a new space much faster.
So it's more capability driven.
Yeah. And then when I think when I think you look at some of the kind of newer kind of Web3, I think there is a natural good question about those, right? And the timeline. Are those technologies relevant? Absolutely. In what period of time? It may not be quite as quick as we thought. And I do think you'll see some of that get regulated. And some people would say regulation is probably a good thing to bring more stability to what is an interesting set of technologies. And typically, technologies are good for solving solutions, and I think we will find the solutions that that technology will solve.
Well, Bob, Katy, Daniel, and Eric, many thanks for joining us here on the Global Dialogue. We wish you and the board the very best of luck here on your India trip, and we look forward to having you back again.
Thank you.
Thank you very much. Well, with that, it is time for us to wrap up this edition of the Global Dialogue. From all of us here on the team, goodbye. Many thanks for watching.
Brought